Hello, I'm Ben Jones and you're watching Dukascopy TV. Welcome to another edition of Target in Focus. Joining me on the line to discuss his predictions for euro crosses over the next 12 months is Josh O'Byrne from Citi. Thank you for joining me today, Josh. Firstly, if we can begin by talking about euro-US dollar projections. Coming up in just a week's time, we have another Fed meeting where many are expecting further tapering. But looking ahead, can I have your short, mid and long-term predictions for this euro-US dollar pair?
So ahead of the Fed, we too expect further tapering of asset purchases, likely in the region of $10 billion. This would take total monthly purchases down to $65 billion. In the near term, we see this working against euro-dollar and expect the crosses continue to move lower towards 135 in the near term. Further ahead, we expect investors will likely focus on the low level of inflation seen across much of the Eurozone and its potential implications for the ECB. The pressure to act will continue to build and that the ECB will be prompted to ease policy further, with a potential LTRO-style credit stimulus in the second quarter and a rate cut in the summer, taking the deposit rate into negative territory. Taken together, we see euro-dollar close to 133 in the midterm and ratcheting up of ECB stimulus, combined with the gradual steps towards the exit on the part of the Fed, we'll see euro-dollar face continued headwinds and take the cross lower toward 130 over the longer term.
Now, the euro has been down against the sterling recently, as Britain's growth forecast for 2014 was hiked from 1.9% to 2.4%. How do you see this affecting this currency pair? And in longer terms, what are your projections?
While we've seen all the official bodies revise up the UK's prospects, OECD, the OBR and the IMF, still see 2014 growth far above the consensus. Indeed, our economists are looking for growth closer to 3.25% this year, and this would be pretty strong versus growth that we've seen over the past few years. So building consensus around this recovery in the UK should continue to support sterling. And in the near term, the February inflation report is going to be an important signpost. We expect the Bank of England will leave forward guidance unchanged, and the robust activity through 2014 will prompt an early rate hike, potentially in late 2014. So in the near term, we see euro sterling continuing to move lower towards 81.50 in the near term and 81 over the midterm, and then lower still to around 79 pence in the longer term.
And finally, the euro has been able to advance slightly on the New Zealand dollar recently, partly down to China's annual GDP being 7.7% as opposed to 7.8%. Looking ahead though, what will be the key events that will affect the Kiwi over the next few months, and what are your 1, 3 and 12-month predictions?
So the key risk for Kiwi in the near term is going to be next week's RBNZ. After the better than expected inflation data from the fourth quarter that we had earlier this week, Citi have a non-consensus call that the RBNZ will actually hike rates next week by 25 basis points. This takes the cash rate to 275, quite juicy when compared to sort of rates you can get in the Eurozone. This could support Kiwi in the near term, and we see Euro Kiwi moving below 160. Indeed, we see the RBNZ likely to be the first central bank to hike, as the domestic economy continues to grow above potential and inflationary pressures build. Further tightening over the coming months to the tune of, say, 4 more hikes could continue to support Kiwi, pushing the cross lower towards 156. Further ahead, we think that the combination of ECB easing and RBNZ tightening could attract yield-hungry investors, and this will see the cross falling nearer to 153 over the longer term.
Thank you for talking to us today, Josh. That's all we've got time for. Monica Gibson will be back with another edition of Targets in Focus on Friday, so make sure you click back for that. Goodbye.